I don't know about you, but I gotta know. Is that bloodbath that started on Friday by the dip? Or boy, is it about to get gnarly. We got the one and only Mr. Dan Bird, who's been a hell of a lot more right than most people. Dan, what say you? Is Friday the start of the bloodbath, or is it just another by the dip?
So what I always say about buy the dip is it could also be catching a falling knife,
For
right?
sure. For sure.
How do you know it's a dip?
Only in
You don't.
hindsight.
You don't. That's right. Only in hindsight. You don't know.
That's right.
So let me. I'm going to share real quick. I'm going to share right now. So
Okay.
I'm going to actually use my newsletter because I just sent it out this morning.
I
I'm
saw
going to
that. I
use
have
my
not seen
newsletter
it
for
yet.
most of our conversation because it was basically kind of around the same topic.
Okay.
A lot of the data is in there. But let me show you this splash screen I used on Friday for my YouTube video.
Nice. Aha.
See
There we
that?
go. Yes. The sea of red. Yeah, it's funny when I look, because again, I know we're talking Sunday, and I wanted to make sure I was at least somewhat prepared. One of the things that I noticed on Friday reading was it seemed to be a lot of rotation, right? You were getting out of the big tech, you were getting out of software as a service, and you were going into um, staples, right? Discretionary bad, staples good. Very much a risk off trade. That's kind of what I noticed, but I'd love to see what's in the newsletter. Love to see if this is the
Funny you should
start of
say
a
that
trend.
because that's exactly what I talked about.
Yes, it's like I
That
was prepared.
that is precisely what happened. Let me
All right.
bring up bring up my website first. So for anybody interested, hang on, let's see. Say okay. Are you, oh, there we go.
Yeah, I can see you.
You see the drop down thing from Zoom? I'm trying to get it to go up. There we go. All right.
Yeah.
Yeah, so this is the website if anybody's interested. Breakpointtrading.net is where to go. The newsletter is in this little box right here. We're going to look at that here in a second. The YouTube channel button is here too. And I know on Zoom or on YouTube, you can't put links in. So your folks have asked in the past, can you post the link? And well, we would love to do that. They just delete it anyway. So really can't. So just go to breakpointtrading.net and click on the button in the upper right up there. And I post every day. We've got about 850 subscribers so far.
Nice.
I'd like to get
Congratulations.
it to 1,000 if we could, but I mean, it'll probably get there eventually.
Oh, it'll get there eventually. It's just a question of when.
So first off, notice the market bias chart right here. That's Friday's movement.
That's 1 day drop. Wow.
1 day drop. It had steadily been going up, and it actually a little bit leveled off towards the end. In fact, on Thursday there was a little bit of a drop Thursday, but the market came back at the end of the day. But this did hardly move. In fact, it didn't move at all. None of that on Thursday's numbers. They were exactly the same as Wednesday's numbers. So it wasn't until Friday where the bottom just fell out of everything.
Okay.
And if we look at, by the way, what I'm showing you here is on the homepage, and there's no subscription needed for all this stuff. So folks can go here and get lots of value just by looking at the homepage. But here's the S&P chart, and one thing that you should notice is it ended the day right at the bottom, right there, which means the only reason it stopped going down is because the market closed.
So typically speaking, you've been educating us for years. Typically, when that happens, there's more selling.
It's more selling. It usually continues into the next day, Monday. Now the other thing is Friday was options expiration.
Okay.
So Max Payne last week.
Sure.
I did a whole YouTube video on Max Payne on Wednesday. Monday the market was closed. Tuesdays I do technical Tuesdays. So I take one technical indicator and I educate people on what it does and how it's created and how I use it, things like that. So on Wednesday I did Max Payne, and that's where Max Payne basically, just to help people understand what that is, it's basically this right here. So it's all of the calls and all the puts, all of the options out there. So if there are more calls, if the market has been bullish previously, meaning more people are buying calls than puts, then in order to get that back to equilibrium where the calls and the puts are equal, and market makers want that to happen because then they don't have to pay out premium. So they save
Right.
literally billions of dollars when that happens.
Mm-hmm.
So if the market has been bullish and there's lots of calls, in order to get that back to equilibrium, the market needs to sell off.
Mm.
So if the market starts selling off, or if there is some catalyst that begins that process, then market makers who usually take the other side of the trade will just step aside, and they won't take the other side. They will let the selling continue.
Got it.
That means it comes back to equilibrium, and all the premium for all of these calls right over here expire worthless, and the market makers save tons of money.
Yeah.
And that's
Okay.
usually what happens for options expiration. And last week was Max Payne week, options expiration. That normally continues into the first or second day of the following week.
Mm.
So that's one of the reasons that I think it will probably continue into Monday,
Okay.
maybe even Tuesday. Now, we have another catalyst next week as well, which is PCE on Friday.
Yeah. Did you see the expectations for PCE? I'm shocked at how bullish they are.
What do you mean? What do you mean bullish? You mean
Well, if again,
hawkish or
dovish, right? Because again,
dovish? Okay.
PCE headline last month was 2.8 or 2.6, expected to go to 2.4, and core was 2.8. I mean, these are big drops for a month. They're both expecting a point 0.2 drop.
Interesting. So I'm going to go to the newsletter. Here's the newsletter, and you can get to the YouTube channel here too if you want.
Mhm.
But every week I put in the calendar. So here's last week's calendar.
Yep.
Um, not too much last week.
Big miss in existing home sales. Big
Yep,
miss.
existing home sales was big, but next week PCE, it's actually showing it's going up. The expectation.
But again, that base effect. So again, the
Right.
expectation for headline, which you have there, is 2.8. It's expected to be 2.6.
Okay.
Or that's core. Sorry, 2.8 core is expected to be 2.6. Headline was 2.6, expected to be 2.4. They're
Okay.
expecting
Well,
both to drop 0.2.
yeah. So if it doesn't, then that will be a surprise.
Woo, yeah, that's what I told my audience this morning. If you get a flat PCE, watch
Yeah.
out.
Yes, that's right. I mean, the base effect should help it, but
Correct.
and I think owner equivalent rents
It's
might
coming
help this month also.
in. Yeah,
But commodities have still been, commodities are still going higher.
yeah.
Commodities are what affected CPI last time, or that's one part of it,
Mhm.
and they've actually gone higher since then.
Yeah, you know what? You know what was really
So,
funny to me on Friday? I'd love to hear this. So the thing that caught my attention, and I spoke about it today on the daily financial news, is anytime a trend breaks. So what happened on Friday? A trend that broke on Friday was, for the longest time, consumer expectations for inflation as they went higher, rates went higher. Right? It makes
yeah.
sense, right? If we're expecting inflation, they expect rates to go higher. That changed on Friday. On Friday, we posted the highest 5-year inflation expectation since 1997, but rates crashed.
Mm-hmm.
Rates went down like 8 basis points on the
Right.
10-year. So I don't
Right.
know what happened on Friday. How can inflation expectations go up meaningfully, but rates go down? It's the economy just cratering but beneath us?
Well, I don't think it is yet, but there could be some um, potential that could happen. If you remember way back in like last September or so, when I was showing my recession watch components, one of those is about 6 months after the first Fed cut.
Mhm.
Normally, historically, there's the recession begins. That would put it somewhere around April,
Mm.
right?
Okay. Yeah.
The other one is the inverted yield curve uninverting.
Yep.
That happened in October. Usually 4 to 6 months later, the recession happens.
It'd
So
actually be
that
interesting to look at because I hear the yield curve's getting pretty close to inverting again.
no, it's not. We can look at it
Okay.
though. Look at the
10 and
charts
2.
page. It's the 2 and the 3 month is,
Okay.
but not the 2, not the 10 and the 2. Let's see. Yield curve. Oh, the yield curve's up here. Here's the yield curve, inverted yield curve. We'll look at a 3-year. So
Okay.
there's the 10 and the 2. It's pretty far away from inverting.
All right.
But the 2 and the 3 month is getting close to inverting, which is actually, it is inverted, I think.
Looks like.
This is the 0 up here. I think a better way to look at this is on the market bias page. I actually have the 2-year and the 3-month inversion, and it is already inverted. So yes, this one is inverted. And it has been since the beginning of the year, basically. It went back above it slightly right there. But
Okay.
this one, it has been inverted, but the key one that most people look at has not.
Yeah, the 10 and 2. Okay, so we're still
Right. So there's the 10 and the 2.
Away.
It is not inverting.
Okay.
But that's another inflation watch component, when that uninverts. So all of those components, the only one that really hasn't triggered yet is jobs.
Mm-hmm.
So unemployment rate,
I think the last reading was
that still has not
4.1.
spiked. That needs to really spike above 4.5.
Yep.
For that to trigger the third component
Yeah,
of
the Psalm rule is no longer in effect. Lots of things have changed.
Nope, that's right. Yeah. So, this there's the rate cuts right there.
Mm-hmm.
So 2 out of the 3 in recession watch implying somewhere around early Q2, somewhere April timeframe, April, May. But the only one that hasn't really hit yet is this one, the unemployment rate. So we'll get that in 2 weeks.
Okay.
We'll see what happens.
Very cool.
But let's go back to the newsletter, because I want to use this for this conversation today.
Mm-hmm.
So I talked about the catalyst PCE inflation next Friday, max pain. We just talked about that. So here is the key right here. So I talk about and you talked about rotation, and this makes rotation really clear right here. We'll look at it with the sectors as well, but this is basically the aggressive versus defensive areas. Mm-hmm. So I said in the last week, they're accelerating to the downside. So they have been going down since the beginning of the year. In the last week, they've accelerated to the downside. It's the same thing that happened at the highs in December 21, just before the cyclical bear market of 22. And this is what they look like. So the one at the top is money flow right here. So you can see this is February. Here's January right back here. So this is the beginning of February. Money flow has been going down. It's actually been going down. And the way to look at this is not necessarily that it went down here and came back up, but look at what the actual market did. So the market came down and went higher, right? Made a new all-time high right there. The market went sideways and then made another new all-time high just last week. So we had 2 consecutive all-time highs right there. Yep. But when it made an all-time high right there, it made a lower on the money flow. And when it made the second all-time high, higher than this previous one, it went even lower on money flow. Okay? So think about the same thing. The market's making new highs over here. Discretionary is underperforming staples. And look how it's accelerating in the last week right there. This is the NASDAQ underperforming the S&P. It's accelerating. Here's technology versus the S&P. It's accelerating in the last week. Here's growth versus value, accelerating. And the small caps versus the large cap tech names right here, which has been going down really since December.
Yeah.
But again, accelerating. So just in the last week, all of these are accelerating to the downside. That is rotation out of aggressive into defensive. So the same thing that happened in 21, just before the 2022 bear market. Wall Street was preparing ahead of time.
Yep.
Retail traders, can do things quickly. Wall Street can't. It takes them, weeks and months to reposition themselves. And it looks to me like that's what they're doing right now is repositioning.
Yeah. Okay.
So the following chart is one that I showed here before as well, but this is based on market cycles.
Hmm.
So you can see the market cycles, typical market cycles right down here. It's accumulation, markup phase, and then a distribution phase at the top, and then we go into a markdown phase. This is what the actual chart looks like updated. This is updated till Friday's close. So, and I said before, I mean, I said this, we didn't meet last week. I think we met the week before. So 2 or 3 weeks ago, I pointed this out, maybe even a month ago. I pointed out that we could be in a distribution phase right now.
Yep.
The market's going sideways and getting ready to go into this markdown phase.
I remember.
Now, the markdown phase does not confirm until we break below this support at 58.50.
Okay.
We're not there yet, but we have broken this down, this trend line right here on Friday. We broke that. We broke below the 21-day moving average, and we're sitting right on the 50-day moving average right now. And the market ended at the low on Friday, which implies it's going to probably go lower on Monday, which means it will go below the 50. And then the next stop, the next support is that 58.50 level.
Okay.
Right there. Now, if we get an unexpected PCE inflation report on Friday, that will be the catalyst. I think the market is ready to do this anyway. But if we get a more hawkish PCE than expected, then I
Well,
think
let's
that's
not forget we also get a monster earnings on Wednesday. Nvidia. Nvidia
yes,
is on Wednesday. That by itself could
that's true. Yeah.
send the market crazy.
Yep, that's a good point. So what I did on this chart, and I explained it up here in the newsletter, is that I put two Fibonacci levels. So I did the gray one is a Fibonacci starting with from the low back here in October of 23,
Okay.
all the way to the high that we just posted last week.
Mm-hmm.
So that's the gray lines here. And then I did another one from the low here in April to the high. That's the blue ones.
Okay.
And I like to do two because I like to see where they meet, where they can coincide.
Mm.
And the first place they coincide is right here on the 200-day moving average. So if we do break below 58.50, then that's the next stop, around 5,700. And if we break that one, then the next stop is down here at 5,400.
Okay.
Now that represents, and I actually put it here, the first one represents a 6% decline. And the second one right here represents an 11% decline. All right.
Mm-hmm.
So I said before that I think we're probably going to have a 10% correction sometime this year. Does not mean it is going to be this one.
Right.
This one could come down to this level and bounce back up. And then in the summertime, breaks down and goes down here to that 10% level.
Okay.
That's probably what will happen. It'll probably find support right here, the 200-day and these two Fibonacci levels. And then it will bounce back up to the 58.50 level. And then in the summer, when the market typically declines, then we'll have the big runoff down here to 5,400.
Okay.
Having said that, I still think we are in a bullish phase. We're still in a secular bull market, and the market still has a chance to end higher by the end of the year.
Mm.
All right, but this next few months is going to be, pretty concerning.
Okay.
The other thing that I did on the website that I added
Well,
on the homepage.
let me
Go
just
ahead.
ask you this
Yeah.
question just to tie what you just said to your portfolio. Does that mean you're heavy in cash right now?
Yes, I am completely in cash right now.
Okay.
I am getting positioned. I am looking at shorts basically.
Oh, you're going
So
negative. Okay.
inverse ETFs. I'm
Yep.
looking for an opportunity there
Okay.
to go into inverse ETFs,
Gotcha.
and I've talked about those before.
Yeah, well,
On
let me make you a suggestion. Maybe next week on Wednesday on your channel, again, go to his YouTube channel. Maybe you could do a show just on inverse ETFs to whet people's appetites.
Yeah, that's a good idea. Yep, that's a good idea. I can do that.
There,
You have to be. You have to be. I'll make a point to say that you have to be careful with
yeah,
those,
oh, for sure. Yep.
especially in a secular bull market, which we are in. So this is the home page right here. You go down halfway down here. These are the secular markets. So you see we are in a secular bull market.
Yep.
All this green right here.
Yep.
And we're not even close to that breaking yet. So you have to be very careful about trying to short into a secular bull.
Yeah, this would be a trade, not an investment.
That's right. It's a trade. It's not for long term.
Okay. All right.
But that's a good idea. So one thing that I added on the homepage, first of all, this is the light where we have an orange light right now. We've got a short-term bear signal that happened Friday.
Mm-hmm.
If we get a medium-term bear next week sometime, then this will turn red
Got it.
into a red light. But I added the S&P and NASDAQ equal weight charts, which is what I put on the newsletter this week. That's this right here. And the reason I did equal weight is because I wanted to take out the effects of the Magnificent Seven,
Oh,
the,
genius.
the large cap tech stocks, right? If you leave the large cap tech stocks in, then these both look pretty similar. They both come up to about the same place, and they both start declining at about the same time. But if you use equal weight instead, it gives you a truer picture of the overall market. And now you can see the S&P is weaker than the NASDAQ, number one.
Mm-hmm.
But you can also see that the NASDAQ has a potential to fall much farther than the S&P,
Okay.
right? So it's just starting to roll over right here, where the S&P has already started to roll over. So that's, again, right on the front page of the website. Anybody can access that. This is the VIX. The VIX has been unbelievably tame down here through this whole period, below 17. Last week, it spiked significantly, went up 16%. Basically on Friday, went up 16%, but still ended in the neutral area in between 17 and 20. Now, if we do get more selling on Monday, I expect this to cross over into the 20 area, and that's where bears take control.
Got it.
So that, again, could be the start of a significant downtrend. And you can see the 12-month rate of change for the VIX also is starting to spike up as well. Here's performance for the week. Looks pretty red. Apple actually hung in there. But if I did it just for the day, everything would look red. If I did just Friday, but this is for the whole week.
Okay.
And you can see the Magnificent Seven, the effect of those. They're almost all except for Apple are red.
Yep. So
NVIDIA is going to be really important on Wednesday.
Yeah, Wednesday, yeah.
It probably will move the market. So here's what you were talking about with sectors. This again will show you rotation. This is for 1 week again.
There you go. Consumer staples, utilities, healthcare, and energy.
Yep. And real estate. All the defensive sectors are outperforming the S&P.
Yep.
The S&P right there. So that's what I look at. These are all outperforming. The ones that are underperforming down here, you've got discretionary at the bottom, technology, communication, NASDAQ 100, Russell 2000. All of the aggressive areas are at the bottom.
Yep.
So that, again, in addition to what I showed you before with the growth versus value, that was rotation. But this is another way to look at rotation. This is rotation out of the aggressive sectors and into the defensive sectors. Exactly what you were saying. There's the rotation chart. You can see all the ones in leading, except technology actually made it into the leading quadrant, but all the other three up here are defensive sectors in the leading quadrant. And discretionary down here, which is, Tesla is one of the largest holdings in that. And Tesla's been doing terrible lately. This is John Carter's squeeze indicator. I've showed this here before. Lots of people seem to like to see this because this shows you the November, December timeframe back in 21, right over here. And this is something that John Carter showed at the Money Show back in November. And in November, we didn't even have these bars
didn't
yet.
Even have one blue bar yet. Yep.
We didn't have one blue bar. So this light blue one here was in November, but he showed this and he says, this is the thing you better watch for. This is a 1-month chart, so it doesn't complete until the month is over. So the one for February technically won't complete until next Friday.
Right.
However, these two here were in November and December when the market at this time was making new all-time highs. Mm-hmm. The market had not rolled over yet. This was the signal telling you, warning you that something is coming. Yep. And the rest of these right here is the bear market of 22. So this is what we now have in December and January, which are complete. So those will not change. They're dark blue. We just got a dark blue in February.
Yep.
just on Friday. In fact, Thursday, that was light blue.
Hmm.
So if this continues going down for the next week, then this will go lower, but it will stay dark blue, and that will
Right.
confirm what we saw over here.
Got it.
We might be heading into, again, what I talked about here months ago, that 25 might be similar to 22,
Right.
right?
Okay.
So
Yeah.
that's
Same
something to
time.
watch for.
Yep.
These are the kind of interesting, the best and worst large caps. Super micro SMCI is number one on the list this week.
Hmm.
It had been doing terribly. Axon is one that had been doing great. It sold off 25% this week.
Well, Palantir as well. I mean, that'd been a dominant.
Palantir, yeah, Palantir's down here too in the top 10. Palantir sold off 15%. And then these are the small and mid caps down here. Celsius, which had a terrible year last year,
Hmm.
had great earnings, was up 46% last week. So that's kind of interesting. Um, this is an article I came across that if you were to just pick 4 investments and hold them forever, these are the 4 this guy picked. So S&P, this one is a fund, a growth fund. This is a dividend fund, dividend stock down here, and this is gold.
Hmm.
So this basically summarizes this article, but the link to the article is right there.
That's nice.
And then this one is interesting too. Margin debt confirmed. This is from Real Investment Advice, which is a great newsletter. I put the link for the whole article, but I excerpted some of it. The interesting parts. So margin debt confirms the exuberance. So you can see margin debt right here. This
Wow.
is in 21 before that 22 bear market. We're right back at the same
So,
place.
so let me just make sure the audience knows what that means. That means there's more margin debt outstanding now than any other time.
Correct. That's right.
So translation means we have another couple of days like Friday. There's going to be a lot of people washed out, which creates more forced action.
More downside action. So what that means is when people use margin, that means they're using more than the actual money they have. They're borrowing money to buy
Mm-hmm. Yep.
equities, which means when the equities go down, especially if they go down sharply. Now, today they made it to the 50-day, or Friday they made it to the 50-day moving average. It's not broken yet.
Right.
The chart is not yet broken. But if it gets down to that 58.50 level, and
Mm-hmm.
especially if it goes below it, then it will absolutely be broken, and all of that margin will start getting called.
Got it.
And that's not a choice people will have.
No, they don't get
They're
asked. Yeah.
right. They won't be asked by their broker to please sell your stock so you can pay off all this money you borrowed from us to buy stocks. The brokers will just do it.
Mm-hmm.
They will just sell the stocks, and all of a sudden you'll have these huge losses that you were hoping to hold on to it because you thought it was coming back.
Yep.
But because you use margin, it doesn't matter.
It doesn't matter. Yep.
Your broker will just sell it for you, just to get their money back.
Mm-hmm.
So that's the problem with having margin debt so high like that.
Yeah.
And then this is a little counterintuitive because he inverted the red line is free cash. Investors have negative free cash. So normally this red would be going down instead of up, but he inverted it so that you can see the relationship with the S&P 500. All right.
So help
So
me translate that. So that means that
the S&P
investors are
500 is
highly
going
leveraged,
up.
right?
Right. So well, let's read this. Look at the red line. Free cash balances, as noted, margin debt supports the advance when markets rise, as investors can leverage additional leverage to
Yeah.
increase buying power. Therefore, the
That's what
recent rise in margin debt is unsurprising. Chart below shows the relationship between cash balances and the market. So cash balances, that means how much cash they have. So this should be going down, which means they have less and less cash,
Exactly. So
right?
so red in this case is bad. It just means
Yes,
that,
that's
and
right.
also they don't have cash. That means they can't cover.
That's
That
right.
means they can't cover.
That's right. They can't cover, so their brokers will sell them out automatically.
Yeah. So
So
this could get violent, is what you're telling me.
this could get very violent. This could be a very fast moving market with all of these things coming into play right now. Now, I will stress that that does not mean it will happen.
No, 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 no.
I'm just saying that the risk of has increased substantially.
Yeah,
And
this could be
that's
a
what
series of dominoes. This was really the 1987 crash. I've studied the 87 crash in
it could
college.
be. Yeah,
And
it could be.
it was a setup that dominoes fell, which pulled in more companies, which pulled in more companies, which pulled in. This could just be
Right.
selling begets more, gets, and it's just violent.
That's right. That's exactly what could happen. Um, this kind of follows on to it. Spread between the leveraged ETFs, leverage long ETFs. More and more retail traders, especially, are getting into leveraged ETFs. And I did a whole session on leveraged ETFs. It's actually on my website for those that are subscribers on the portfolios page. Down here, I show you what the leveraged ETFs are for both long and inverse. And I'll do a session on this on Wednesday.
Perfect.
But I also put in here, click here to learn. Well, that's the cloud. There's one for leveraged ETFs to learn about leveraged ETFs
Oh, look at you.
and what they mean and what happens because 3x leverage ETF means it's 3x. So if the market goes up one time, it goes up three times. Well, if the market goes down one time, it goes down three times as well.
Yep.
So that's what this basically is saying on the Lance Roberts does the RIA, Real Investment Advice. This is what he's saying. He says a lot right now, in addition to all of this up here, all of this margin, you've got a lot of people using margin to buy leverage ETFs.
Oh, margin on leverage. Ooh,
Right.
that could
Right.
be fun.
So that could accelerate it as well to the downside. So yes, we are sitting on a very, very risky powder keg right now that any kind of catalyst could ignite this
Yeah, this
and
could
start
be a
it down.
very short fuse. This could get.
Right. Now, having said that, if we go back to the homepage and look at the secular bull and bear markets, because you mentioned the 1987 crash, that's right there.
Yep.
In the overall scheme of things during this secular bull market, this is nothing but a blip.
Yeah, didn't the 87 crash, didn't it fall like, what was it, 21% in a day or something?
Yes, right. In a day. It was a huge one day crash. I mean, potentially, and it was on a Monday too.
Yeah, it was. Yeah, and again, just so everybody knows, that can't be repeated. There are now these things called circuit breakers that wouldn't let that happen in a day, but it could
Well,
happen in a week.
yeah, because what happens with the circuit breakers is when it gets to a certain point, I don't know, it's 5% or 7% or something
Yeah.
within a few hours or something, the market just shuts down.
Yep.
So the market will shut off, so no more selling can take place, and it will force everybody to take a step back and think about what's going on. But once it starts up again, the selling could just continue.
Sure.
And the circuit breaker could hit again and stop the market. But the issue is that when the circuit breaker takes effect and the market is closed, you can't do anything.
Correct.
That also means you can't get out of your losing positions.
Yeah, exactly.
Right. So you've got to wait until it comes back up and opens up again to get out of your losing positions, which means how do you do that? You sell.
Yeah. Yeah.
So even more selling will happen. So yes, it won't happen in one day, but it certainly could happen in 1 week.
Yeah,
But
exactly.
the important thing about this is, and I highlighted both of these, the 1987 crash, as bad as that was hardly a blip in this secular bull market. And the COVID crash, as bad as that was hardly a blip in this secular bull market that we are still in. So while it will get ugly and it could get ugly quickly, I think overall we are still in a bullish trend.
Yeah.
I don't think that's going to change until our debt starts collapsing things, and that's going to be still a few years away.
All right. Well, this is going to be an exciting week. Nonetheless, we're going to get some education on inverse ETFs. We've got NVIDIA. We've got PCE. You got to go subscribe to Breakpoint Trading on YouTube to get all of these educations, his newsletter, all of that. Dan, thank you so much.
You bet. Have a good weekend, and everyone be careful, be cautious out there. Have your stop set.
Have your
I've had
stops.
subscribers already tell me I've moved my stops up already. Thank you.
Good.
So
I like it.
I'm in
Thanks, buddy.
cash though. All right. Have a good one.